Okay, so we've formed a partnership, and throughout the year we operate the business as normal. Remember, partnerships record revenues, expenses, etc. the same way in the journal as any other form of business. So in other words, service revenue, you perform a service for 5,000 cash. You would debit cash for 5,000, you credit service revenue. Does not matter if you're partnership, proprietorship, or corporation. Revenues are treated the same way for the most part, as well as expenses. Wages expense is the same regardless. You would record it as wages expense, debit, credit, cash. So those types of daily transactions are the same across all platforms, whether it be a proprietorship, a partnership, or a corporation. Same way with purchase equipment. You buy a building for 100,000. Well, everybody's going to record that building at 100,000. Debit to building, credit to cash, or credit to note, depending on how you pay. So when we're looking at partnerships, we're trying to look at things that are specific only to partnerships. To see this, let's look back in time to the proprietorship. Remember, a proprietorship worked as normal throughout the year and recorded revenues and expenses. At the end of the period, we produce financial statements. Then we close the books. The next time we will look at um, the next item we will look at as a partnership is the closing process. Remember, in the proprietorship, we had four closing entries. We closed revenues by debiting them and crediting income summary. We closed expenses by crediting them and debiting income summary. Then we closed income summary to capital. And then last, we closed the drawings by crediting the drawing and debiting capital. So let's look at the proprietorship company who had only two accounts. Let's say they only had service revenue account and they only had a miscellaneous expense account of 60,000. This resulted in net income of 40,000 for the period. How would we close the books? Remember, closing the books simply means we zero out the temporary accounts at year end. Temporary accounts are your revenues, your expenses, and your drawing account. So again, this is a very simplified version. We've got one revenue, we've got one expense, and that is it. So to get rid of the revenue, remember it says revenue of 100,000. Well, typically revenue of 100,000 means you have a credit balance in your revenue of 100,000. So to zero that out, you would need to debit your service revenue for the 100,000. That's first and foremost. Well, where are we going to place that? We're going to place that into income summary, and we're going to credit our income summary as the offset. So that's step one. Close out all of your revenues. Step two is close out your expenses. Again, we're a very simplified version here, and we're talking about just one expense, miscellaneous expense. It has a balance of 60,000. Well, expenses by nature have a debit balance, so that implies we have a debit of 60,000. So to close the expense, we would need to credit the actual miscellaneous expense account. Let's see here. Make sure we are typing correctly. So miscellaneous expense, we would credit it for 60 to zero it out. Had a debit balance, you need to credit the account to zero it out, and we would debit income summary. Now notice, what is the balance in our income summary once we debit for 60? We had a credit of 60, or excuse me, a credit of 100,000 to income summary, a debit of 60, leaving us a net credit balance of 40,000. So since this is a net income, we should have a credit balance of 40,000. That's where we're sitting. Net income of 40 should translate to a credit balance of 40 in the income summary. So to close it out, we debit the income summary for that remaining income balance of 40,000. Where does that go? Well, in a proprietorship, it simply goes into that proprietor's capital balance. So we're going to put it into their capital at 40,000. Now, in this case, we didn't need to divide income. This was a proprietorship. There was only one actual owner of this company, so all of that goes into capital for that one owner. But what happens in a partnership when you have two or more owners? See the issue there? How would we divide that 40,000? This is what the division of income means. It is not a physical payment of income to our partners. It is simply the method we use to allocate the income to the partners during the closing process. When we're preparing our books, we have to close that net income out to the capital. Division of income is how we allocate that out. We calculate it based on their partnership agreement. Now, there are several ways income can be divided between partners. It can be equally divided, it can be based on income ratio, it could be based on some form of salary or interest or a combination of factors. So, when we look at this, we're going to look at a few examples, but keep in mind there's numerous different ways that a company or a partnership could decide to allocate out their income. We're looking at some of the common methods. So let's look at this. We've got Parker and Moss operated during 2013. At the beginning of the year, Parker's capital totaled 50,000 and Moss's capital totaled 45,000. During the year, the company reported net income of 38,000. What that means is we have that credit balance in the income summary account sitting there at 38,000. Record the journal entry to close income summary to the partner's capital accounts based on the following independent scenario. So 1, the Parker and Moss agreement states all income should be shared equally between the partners. So what should happen in that case? And I apologize, I do not have enough lines. I'm going to add one there. Well, if it should be equal between partners, you would simply take the total income, and in this case it's 38,000, and we're going to divide it by 2, which gives us $19,000 per partner. So we need to close out the income summary. So remember, we had net income of 38,000. So to close that out, we need to debit the income summary for 38,000. Then, where is it going? Well, remember we have two partners. We've got Parker partner and we've got the Moss capital account. So we need to allocate it out. Well, in this case, it says it's split equally, so each of those partners would get 19,000 of that income. So that's the simplest possibility. It's equal. Also, if a company failed to mention in their partnership agreement how it's split, legally we usually split it equally. Since no agreement exists, by law it would simply go out equally to all of our partners. All right. Now, what's the second possibility? The Parker-Moss agreement states income is to be divided based on an income ratio of 4 to 6. So again, remember, in this scenario, we've got 38,000 in income, and that income needs to be split between two people. And I'm going to abbreviate. Parker needs a portion of it, and then our partner Moss needs a portion of that 38,000. Well, how do we figure out their portion? Well, in this case, we've got an income ratio of 4 to 6. Well, to convert ratios, all you do is add them together. Basically, what we're saying is there's 10 slices of pie. Parker gets 4 slices, Moss gets 6 slices. It's always in the name of the hierarchy. It's respectively. So Parker and Moss would be 4 to 6 respectively. However they're listed in the agreement there, it also lists the income ratio the same way. So 4 to 6 would be Parker 4 slices out of 10, Moss 6 slices out of 10. So we'd take that 38,000, remember it needs to be split into 10 slices, so we'd times that by our 4 out of 10 for Parker, and we'd times it by 6 out of 10 for Moss. We're going to split that based on that ratio. So take 38,000, multiply that by 4 out of a possible 10, and that gives us 15,200 is going to Parker. Do the same for Moss. Take the 38,000 times the 6 out of 10, and that gives us 22,800. In the end, if you were to add those two pieces together, you should come out to 38,000. I always recommend double checking your math there just to make sure. Well, now how would we journal it? Again, I apologize, I don't have enough lines there, so we'll add one. Again, income summary goes out at 38,000. That's the amount of income we're trying to split. Now, based on this scenario, we would do our capital to Parker for 15,200, and then Moss we would do at 22,800. Okay, so that's the entry that would be made once the allocation of income takes place. All right, next one. Parker and Moss agreement states income is to be divided with a salary of Parker of 20,000 and a salary to Moss of 10,000. The remainder is to be divided equally. So again, let's look at these two members. We've got Parker and we've got Moss. And I hope you don't mind me putting P and M there. It's just easier in the scope of things. So this one's a little bit different. The first thing we have to figure out is their salary allocation. Well, Parker gets a salary of 20,000 and Moss gets a salary of 10,000. So how are we going to allocate that out? Well, that's guaranteed. So that's a total of 30,000 in total, right? Well, how much do we have to allocate? Well, remember we've got 38,000 in income, so we need to allocate out 38,000. So that's going to leave us 10 or 8,000 left, right? We've got 38,000, we've allocated 30. That leaves us 8. Well, how's that remainder supposed to be allocated? Well, it's equally. So you're going to take that and say, okay, 8,000 divided by 2 gives us 4,000 each. So in addition to their salary, they're each going to get 4,000. So that's going to bring us to 24,000 for Moss and 14,000, or excuse me, 24,000 for Parker, 14,000 for Moss. Again, if you were to add those two together, that should equal your 38,000 that you have to allocate. Again, the entry, we'd hit our income summary for the 38,000 in income, and then we've got two partners, and again, I apologize for that missing line. Parker Capital would get hit for the 24,000 that we allocated, and then Moss Capital would get hit for the 14,000 that we allocated there. Okay. All right, one last scenario here, and I'm going to skip down to that next page. The Parker-Moss agreement states that income is to be divided with a salary to Parker of 15,000 and salary to Moss of 15,000. 10% interest on the beginning capital balance and the remainder to be split equally. All right, so now this one's a little bit different, so let's set it up a little different. Let's actually do a schedule to see. Remember, we've got two partners. We've got Parker and we've got Moss. And then we've got total income to be allocated. Now, the total to start with, again, was 38,000. So let's start with our salary allocation. Now each of our partners gets a salary allocation, so let's look at Parker, and then we get a salary allocation for Moss. Alright, so Parker's allocation was 15,000. Then we go down here and Moss's allocation was also 15,000. So that brings us a total allocation of 30,000. Well, how much income does that leave us with? Well, we had 38,000. We've allocated 30. That leaves us with 8,000. Now the next thing we can look at is the interest. Remember, it said in addition they get 10% interest on their beginning balance. So again, we've got our two partners here, Parker and Moss, and it said 10% on their beginning. So let's scroll up here and find the beginning balance. So Parker's capital started with 50 and Moss's with 45. So if 10% of each of those, 10% of 50 would give us 5,000 for Parker, and 10% of 45,000 would give us 4,500 for Moss. So let's go back down here. Again, that's 10%. So for Parker, that was 50,000 times 10%, so that's 5,000. And for Moss, that is 10% of 45,000, which was 4,500. All right, so when we add those two together, you take the 5,000 and the 4,500 gives us 9,500 in allocation. Now, you're thinking, wait a minute, we just allocated more than we had. That is true. It is possible because, remember, salaries and interest are guarantees. So how much does that leave us to allocate? Well, that leaves us at negative 1,500 to allocate. Now, any remainder is to be split 4 to 6. Now, keep in mind that remainder can be negative. So we're going to go down here and we're going to do the remainder. And the remainder for Parker would be 4 out of 10, so 4 tenths. So we'd take that 1,500 times 4 tenths and we get 600. Now notice that 1,500 is negative. So that's going to be a negative 600. Again, how did we get that? Well, remember we've got negative 1,500 remainder. We're going to times that by 4 tenths for Parker. And that gives you that 600. And then for Moss, we're going to take that same number and we're going to times it by 6 tenths. So in order to get Moss's allocation, we would take 1,500 times 6 tenths, which should give us our $900 difference, right? Which it does when we check our work. So that means we've allocated out the 1,500. So that gives us a total of 1,500. All right, so if we were to test this out, that means we have fully allocated all of our income. We have 0 left to allocate, okay? So what does that bring our total to? Well, for for Parker, we would look at this and say 15 plus 5 gives us 20,000 minus 600 leaves us with 19,400. I'm going to go down one line just to get that set up right. So 19,400. And then for our Moss, we would take 15,000. We would add 4,500 and then subtract the 900. So Moss is going to get 18,600. Again, if you add those two together, hopefully we come out to that 38,000. So let's journalize it. Again, I'm going to apologize for not including that extra line there, but you can add one. So Parker Capital, again, we figured out to be 19,400. And then last is Moss's Capital, and that is going to get hit for 18,600. That concludes our division of income.